Recession, people are familiar with, economists use the term all the time, and it has a numeric definition. It's two or more consecutive quarters of declining GDP. There are a couple other factors that go in, but that's the basic rule of thumb. So two consecutive quarters, two or more of declining GDP, that's a recession. And of course, we had a recession, at least in the United States, actually probably most of the world. A depression is different. Economists, first of all, don't like the word depression because it's more subjective. It's not as quantitative. It involves a lot of psychological, behavioral variables, if you will. But depressions are real. They happen, and we're in one now. But economists just don't like to talk about it. They've kind of banned the D word, as I put it, from the vocabulary. So a lot of people assume that if a recession is two quarters or more of declining GDP and a depressing outcome, and that's not the definition. You can actually have growth in a depression, but the point is it's depressed growth. It's growth below trend, below potential. And for that matter, I think you could make a good case that we've been in a depression since 2008. You look at the recovery. Okay, we had a recovery from 2009 to 2019. It was the longest expansion in U.S. history, but it was also the weakest expansion in U.S. history. The average annual growth during that entire 10-year period was about 2.2%. Whereas in all recoveries post 1980, the average recovery was 3.2%. So there's an example where you had growth, but it was a full percentage point below trend, below what we had done previously. If you go back even further to the end of World War II forward, average recoveries were closer to 4.5%. So if that's the potential in a developed economy and you're growing at 2.2, that's depressed growth. We can leave the definition of what happened for those 10 years for another day. But now the point is we've had a technical recession. But that aside, we're in a period of depressed growth. So right now, the inflation is coming from the supply side. It's coming from energy price increases, which are obvious, shortages. And the problem in Europe, I wrote the other day, I said there comes a time when the price doesn't matter because you can't get the energy at any price, where it's actually there actually isn't any. Bid whatever you want, but there just isn't any, and Europe's getting close to that point. But as far as monetary policy is concerned, the Fed doesn't drill for oil, Fed doesn't drive a truck, Fed doesn't plow farms and pick corn and all that stuff. They can't do anything about it. What they can do is destroy demand. But because it's not coming from the demand side, you've got to do like twice as much destruction to really cool off the supply side. And as I say, in the 70s, it did flip. And again, going back to the narrative thing, where demand pull inflation is scary because the name comes from the fact that you're pulling demand forward. And I remember in the 70s, if you wanted a new car or refrigerator, you said to yourself, I better go buy it now because it's going to be more expensive 3 months from now or 6 months. It's going to cost me a lot if I wait. That is not true today. That has not kicked in. The inflationary expectations are not up that much. People are feeling the price increases, real CPI. There's no doubt about that. But people have tended to say, yeah, that's really bad. The demand for gasoline is kind of inelastic if you got to go to work or drive your pickup truck or whatever. But the way people afford it is they say, well, we're not going out for dinner this weekend, or I'm not going to buy a new winter wardrobe, or we're not going to take a vacation. So you do destroy demand in other sectors, more elastic sectors than gas and diesel. Price increases are real. It's causing real damage, but it's nothing the Fed can do anything about. But every day you get a little closer to that demand pull. You get a little closer to that change in psychology. We're not there yet, but if this supply side inflation persists, we may get there, and then forget it. Now you're on your way to 15% inflation. Well, here's another irony. Having just resurfaced from a deep dive in the supply chain, there's something called the bullwhip effect. So go back to last November when their shelves were empty. Not every single shelf in every single store, but selectively. Where's the paper towels? Where's the hot sauce or whatever? And you just couldn't get stuff. And that's still true. It's moving around a little bit. It's going from like cream cheese for cheesecakes to baby formula, which is much more serious, but you still can't get the baby formula. So what did retailers and what did distributors do and wholesalers? Well, they said, I'll triple my order. I can't get any, or I can't get enough, so I'll triple my order. Well, now all of a sudden, some of the bottlenecks are being relieved. The triple shipments are showing up, but the demand has collapsed for reasons we've discussed. So now the warehouses have gone from empty to being full to the rafters, but you can't sell the stuff because the economy's slowing down. So what do? You cut prices a lot. And first of all, you don't order anymore. So that feeds back to the factory level. So shutting down the factories, and we're seeing that in China. But it's very expensive to maintain inventory because you got to finance it. And interest rates are going up. We talked about that. So what you do is you cut prices. So tell me what that does for retail margins.
So the barbell strategy is, if I told you that we were definitely going to have inflation, you would know exactly what to do. Get gold, real estate, the kind of hard assets we were describing. Don't have bonds because they don't do very well in inflation. If I told you we were definitely going to have deflation, you would also know exactly what to do. You'd have more cash, you would have notes because interest rates are coming down, etc. What if I said that we're on the knife edge, that we could have a lot of inflation, or we could have more pronounced deflation? How would you structure your portfolio? Well, you have to be prepared for both. So I call this the barbell. We got two weights, which are basically your asset allocation either end, and a connector in the middle. So your inflationary hedges are gold, hard assets, and the things we mentioned. Your deflationary hedges are 10-year treasury notes, etc., because as rates come down, bond prices go up. And your connector is cash. Have maybe a 30% allocation to cash. And people say, well, Jim, I hate cash, it has no yield, why would you have it, etc. A couple answers. Number one, cash is actually a hedge against deflation. In deflation, the value of the cash goes up. Everyone knows in inflation, the value of your cash goes down. Well, the opposite is true. The value of your cash goes up. So you have a deflation hedge right there. It also reduces the volatility of the portfolio. It's the opposite of leverage. So if you got gold and things are volatile over here and notes are volatile over here, that cash will reduce the overall volatility so people can sleep at night. But the most valuable part of cash, and people don't get this, it has embedded optionality. If you're the guy with cash, you can, first of all, you can pivot. If either inflation or deflation takes the lead, you can pivot into that side of the barbell. But more importantly, if there's a catastrophic crash, you can take a deep breath, your wealth is preserved, and you can be the one who goes out shopping. And by the way, our friend Warren Buffett has over $115 billion worth of cash on the balance sheet of Berkshire Hathaway. He sees what I see. He sees this kind of meltdown coming. Instead of going shopping now, wait until things are on sale. Mario Draghi, he knows that central banks are impotent, so the less said, the better. You have this aura of power, even though you don't really have any. But he gave a lecture a few years back, and in an academic setting, you let students ask questions at the end. Well, there was a guy I know who was a reporter, but it was an open event, and got in the queue and got to ask his question. He said, Governor Draghi, what's your opinion of gold? He didn't elaborate, just asked the central banker about gold. And everyone says, well, central bankers hate gold. But Draghi said a very interesting thing. He said, well, before I was head of the ECB, I was head of the Banca d'Italia, the Italian central bank, and I never sold an ounce of gold, not one. I considered it a hedge to the US dollar. And it was an honest answer. And I applaud his candor, but I was shocked to hear central bankers say you had a hedge against the US dollar with gold. That's what he said. That's where the gold comes in.
First of all, I have a one-word piece of advice for any Bitcoin holders. It's called Tether. Tether has never accounted for the dollar proceeds, and there's good reason to believe that they take the dollars and invest in Bitcoin. So that makes the Tether-Bitcoin relationship the biggest Ponzi in the history of the world. And as far as Bitcoin being some kind of reserve currency, that's nonsense, because reserve currencies aren't actually currencies. They're bonds. In other words, people say, the dollar is the leading reserve currency in the world, with 60% of global reserves. But it's not as if the People's Bank of China has pallets of $100 bills in the basement of the bank. They have U.S. government securities that are denominated in dollars. So you can't have a reserve currency unless you have a liquid bond market with all the surrounding plumbing of a bond market. You need primary dealers, auctions, when issue trading, futures, options, hedging vehicles, payment systems, and the rule of law, all of which would take at least 10 years to build, maybe 20, if you could. The U.S. has been doing it for 230 years. But the point being, people don't invest in currencies, they invest in securities denominated in the currency. So where's the Bitcoin bond market? Well, the answer is it doesn't exist. But here's the thing about Bitcoin. There will never be a Bitcoin bond market. The reason is, and it shows that the applied mathematicians and developers, Satoshi Nakamoto, if it, assuming that's whoever that was, if it's not a team from Raytheon, let's say, they basically say, we hate central banks. This is public. We hate central banks. They print too much money, blah, blah, blah. So they put a cap on Bitcoin. That shows that they know nothing about monetary economics. Bitcoin's capped, I think, around 21 million coins. That could be off a little bit, but that's approximately the number. But the amount of electricity and computing power and mathematical application you have to go through to generate each additional coin gets exponentially greater. So you'll never get to the last coin, but you'll get close. And we're almost there now. We're at about 18 million coins outstanding. And then it stops. Well, if you fix the amount of currency, but the economy continues to grow, I mean, the Bitcoin groupies didn't like central bank printing. Well, central bank printing can be abused and has been abused, but if it's done correctly, the money supply grows in accordance with the economy. And that's why gold is so attractive, because gold is not static. The output is about 1.6% a year of the above ground supply. Population growth is about the same. Real growth can be a little bit higher, but it pretty much, it syncs up pretty well, economic growth. But if you stop Bitcoin here and the economy continues to grow, that's naturally deflationary, meaning each Bitcoin buys a bigger piece of this economy. And that's why people like Ray Dalio and Paul Jones are running around talking about, $100,000 Bitcoin or more. Why not, right? But the problem is you'll never have a bond market, because why would anybody borrow in a deflationary currency? You have to pay back more than you owe. The point is, it stands in the way of a bond market because borrowers want inflationary currencies, not deflationary currencies. And the result of that is you'll never have a bond market, and therefore it won't serve as a reserve currency. It's just, if you want to gamble, go for it. I mean, I'm not against it. I'm not saying don't. It should be outlawed. I think people should be able to, kind of waste the money any way they like. Interesting times. I guess the point I would make is that depressions are intergenerational in their impact, and we'll be feeling the effects of this for not 30 months or 30 weeks or 30 months, but for 30 years.